Hey guys, welcome to Learning Accounting. I'm Jim Abdulkabir, the founder of Learning Accounting, and this particular channel is expected to treat all related accounting issues, especially for professional accountants. So we'll be looking at courses like financial reporting, corporate reporting, or strategic business reporting for all type of exams, be it the ACCA exams or the ICANN exams or other related tertiary education exams like the masters, the postgraduate or the undergraduate issues. All those exams, we'll be looking into them. Now I would like you to watch the video and drop any questions in the comment section, and I'll be here to answer your question for you. So stay tuned and watch the video to the end.
Hey guys, welcome to Learning Accounting. Today we want to look at financial instruments, but specifically on convertible instruments. So I want to look at a question on convertible instruments that would cover initial recognition of how the instrument should be treated and subsequent recognitions. So let's jump right to the question and then we'll see what it has for us. Okay, so here we have a question, and the question requirement is asking us to discuss relevant computation on how the above financial instruments should be accounted for in the financial statement for the year ended 31st May 2018. So here's a question that it's on the convertible instrument. It has asked us to discuss, so while I will be solving the question, I would also be discussing them with you. So the question says ATC issued 2 million convertible bond on 1st of June 2015. The bond had a term of 3 years, so we have the maturity period, and were issued with a total fair value of 200 million, which is also the par value. Interest is payable annually in arrears at a rate of 8% per annum, and bonds without the conversion option attract an interest rate of 9% per annum. So the 8% there is the nominal interest rate, while the 9% there is the effective interest rate. The company incurred transaction costs. Sometimes you could see it as issue cost, sometimes you can see it as direct cost, of 2 million naira. If the investors did not convert to shares, they would have been redeemed at par. At maturity, all of the bonds were converted into 120 million ordinary shares of $1 of ATC. No bond could be converted before that date. The directors are uncertain how the bond should have been accounted for up to the date of the conversion on 31st May 2018. So you can see here the issue date is 1st of June 2015, and they're asking us to treat it to the conversion date, and has been told that the impact of the transaction cost is to increase the effective interest rate by or to 9.38%. So from 9% it would increase because of the impact on the transaction costs. Okay, so we can see there's an impact on the transaction cost, which we would have to also consider while treating this particular instrument. So first of all, this is a convertible instrument, and in line with IAS 32 presentation, financial instrument presentation, convertible instruments are instruments that have both debt and equity component. So you have to separate the debt component from the equity component by doing a split accounting technique on the instrument. And to do so, we are going to have, so we have the solution here. We have the years. So the instrument, we have 2016, 2017, 2018. We have the cash flow. Now the cash flow on the instrument is the nominal interest, which in this question is 8% on 200 million. So we have 8% times 200 million. Of course, I'll be abbreviating the figures in million terms. So 8% of 200 million, of course, that should give us 1.6. Well, let's confirm it. 200 multiplied by 0.08. 200 multiplied by 0.08, that's 16. So we have 16 in year 1. We have 16 in year 2. But year 3 will be interest and principal, so we have 216 in year 3. Discount factor at 9%, which is the effective interest rate. So we have 1 divided by 1.09, and that gives us 0.917. 0.917 divided by 1.09, and we have 0.842, approximately 0.842, and we have it again divided by 1.09, and it gives us 0.772. Okay, the next thing we have is the PV, the present value, so we'll be multiplying through as well. Let me bring my calculator to this side of the screen. We have 16 multiplied by 0.917, and that gives me 14.7. Let's approximate it. 14.7. Then we have 16 again multiplied by 0.842, and that gives me 13.5, approximately again 13.5. Then the last we have is 216 multiplied by 0.772, and that gives me 166.8, approximately 166.8. And we'll be summing on up. We have 14.7 plus 13.5 plus 166.8, and that gives us 195. Now 195 is the PV of the lease lab of, sorry, I use the word lease liability, PV of the liabilities. Now that we have the PV of the liability, the face value of the bond remains 200. Let me also put my abbreviations in millions here. So the difference between them will give me the equity option, and the equity option should be 5. The equity option should be 5 in this case. Okay, so this is the, what they call it, equity option in respect to this particular financial instrument. Now we have the direct cost. So let me drop it somewhere here with a different color of marker. Now direct costs are costs that are directly attributable to the instrument, and these costs, depending on the nature of the costs, it has its treatment. For the purpose of a debt instrument, we are supposed to deduct the direct cost from the face value of the instrument. The direct cost is 2 million, which we have to subtract, but if you look at it carefully, 2 million is 1% of 200,000. Therefore, we can as well just say multiply by 1% to get the direct cost on this. Multiply by 1% to get the direct cost on this. Again, 2 over 200, like I said, is just basically 1% of the total face value of the instrument. So 195 multiply by 0.01, which is the 1%. We have 1.95, 1.95, of course, in brackets, and we have also 5 times 0.01, and that gives us 0.05 as well. 0.05. So we can subtract to get our opening balances. So we have 195, of course, minus 1.95. 195 minus 1.95, and that gives us 193. Let me approximate it as well to 193. So we have 193.05. We should leave it like that. And 5 minus 0.05, that gives us 4.95. Of course, if we sum this up, plus 193.05, you can see we have 198. Of course, which is the same thing. 2 minus 200 gives us 198. So that's the opening balances in respect of this particular instrument. Now, the initial recognition. When you consider the double entries, the first thing we did is to debit the what they call it, proceed or cash, which is the amount you are receiving, which we are saying is 200 million. But we then credit equity option, and the equity option we are crediting is 5, and we credit liability with 195. But direct cost was incurred. And this direct cost, we are going to debit equity option with 0.05. We are going to debit the liability with 193.05, and we credit 0.05, then 1.95. That's what we have, 1.95, and we credit our cash or proceed, meaning what we are receiving is actually reducing to 2. In summary, is what we have at the end of the day in our books, which is what will be recognized. Subsequent recognition. Now, subsequent recognition, we use the amortized cost table, because the instrument, like I said, is a debt instrument, and debt instruments meet the IFRS 9 recognition criteria to be treated as amortized cost, and that's why we are doing that. So we have years, again, 2016, 2017, and 2018. We have the opening balance. We have the effective rate. Now, the effective rate has changed as a result of the effect of the direct cost, which is 9.38%. So we have here, let me just note it down, 9.38%. We have the nominal. Nominal is already constant on the face value, which is 8%. And we have the closing. So, opening, what do we have? We have 193.05. That's the opening balance. 193.05 as the opening. Effective is, or nominal, is constant on the face value of the instrument, which is what you pay to the holders of the instrument. So you have 16 all through. While effective is on the opening balances. So we have 0.0938 basically multiplied by the opening, which is 193.05, and that gives us 18.1 approximately. 18.1 approximately. So we have 193.05 plus 18.1 minus 16. Okay, let me do the calculation again. 193 is, I missed it, 1 plus 18.1 minus 16. Okay, so you have 195.15. These, of course, will be non-current liability in that particular year and becomes the opening in year 2. So 195.15. We are going to do 0.0938 again, multiply by 195.15, and that gives us 18.3 again. 18.3 approximately, and we have 195.15 plus 18.3 minus 16, and that gives us 197.45. Again, non-current liability, and this becomes opening in year 3. 197.45 multiplied by 0.0938, and that gives us 18.5. 18.5. So we have 197.45 plus 18.5 minus 16. I can see we have an approximate of 200 there. We have an approximate of 200, and that goes to current liabilities. So these are the treatments. The effective interest rates will be treated in the finance costs in the profit or loss section for each of the period. It will be the finance cost recognized, while these are the figures going to the statement of financial position, as you can see. Then at the conversion point, what do we do? Because the question has informed us that we are going to convert all our shares, all our instruments to, they said all at maturity, all of the bonds were converted into 120 million ordinary shares of $1, of £1, sorry, of ATC. In that light, we are going to debit the liability because we are not going to be giving them cash anymore, 200. We are also going to debit equity option. An equity option will be 4 points. Let me quickly go up to show you guys again. That's 4.95 equity option. So we have 4.95, and then we credit share capital because we are now issuing shares. So credit share capital of 120, since that's what they are converting to, and then credit share premium. Of course, anything above the par value becomes a premium. So we have 204.95 minus 120, and that's what will be recognized as your premium. So we have 204.95 minus 120, and we have 84.95. 84.95, and that is your share premium in respect to this question. So this is how you treat a convertible instrument. So quickly, if you go through it again, first thing we did was to separate the debt component from the equity component. Then we considered eliminating the direct cost because it's attributable to the instrument. After that, I showed you the initial recognition double entry criteria, which is normal. And subsequently, I said these instruments are carried at amortized cost, which we also use the amortized table. And finally, we show the double entry at the conversion point, how it should be treated. I hope this would help you to understand this better. Check out the notes on the links on the comment section. You'll get a link for that to download the notes. And if you have any question, feel free to drop it on the comment section and I'll be there to answer it for you.
Now that you're done watching the video, I'm sure it was insightful and it was educational. Make sure you subscribe on our YouTube channel and like our videos, and also share these videos with other friends who might likely have the same exam as you. And I'm sure we'll be seeing again in another session. This is Learning Accounting.